Hello, I'm Adam Grimes, and welcome back to Module 2, Unit 4 of the Art and Science of Trading. So today's topic is trading ranges, support and resistance and action. We've looked at support and resistance in isolation as a theoretical concept. Today we're going to see what happens when support and resistance interacts with prices and to see the types of effects it can have on market structure. So before we jump in, we've talked about trends. And trends are directional. The idea when a market is in a trend is basically price is going someplace else. We've been one place and the market is ready to move to another price level. Trends are areas where the market tends to be a little bit more emotionally driven. They are certainly dynamic. And by dynamic, to different degrees, there are lazy trends. But the basic idea of a trend is we're in one place and we're going someplace else. This is driven by critically an imbalance in buying and selling conviction. Now, on the other side, of course, are ranges. Everything I've just said about trends, pretty much the opposite is true for ranges. Ranges are non-directional. Prices tend to kind of bounce and stay around the same place. Forces tend to be in balance, buying and selling pressure. If you think about the idea of a trend, so you're here and you're going here. And what we see in a range is more like whenever a price gets too far out of whack on one side, it moves back in the other direction. Trends can often be very emotional, and by comparison, trading ranges can be very boring. Now, the end result of all of this is really here. The patterns of trends tend to be a little bit more readable, and trading ranges tend to be less readable. The reason is because, at least in my experience, my belief has evolved so that I think action within ranges is more random because we're in more balance. And compared to trading ranges, trends are less random, or there's more non-random action. And also, as I hinted at a moment or two ago, trends really are a type of action that breaks support and resistance. It's actually one definition of a trend. If you have this resistance level here, we keep breaking the resistance level as the market moves higher. By comparison, trading ranges are areas where support and resistance hold. So a critical and very important difference. Now, you have a market that's trending and it goes into a range. So this is the idea of thinking about ranges in terms of functional analysis. What I mean in this context, specifically for the market, is just simply what is the range doing? And what we typically will see more often than not, and literally I mean more often than not, you'll see something like this, where the market will go into a range, and that range will turn out to be a continuation of the trend. In fact, all of these little pullbacks that we talked about in the previous one of the previous units, these are in many cases trading ranges, or effectively are trading ranges. They're continuation patterns. This is our normal expectation is for continuation. Now, it certainly is possible that we could have ranging action that could end up being a trend reversal. This does happen. It's a little bit less common. Continuation ranges. Most ranges are continuation patterns. That should be, all other things being equal, that should be your first thought. The concept here is that we believe in the integrity of the trend. And please understand, when I say we believe in, this is not, it's not something we've chosen to believe in. We believe in it because there is analysis that shows that on certain time frames, some markets trend. Momentum works, basically. This is an expression of momentum. All other things being equal, we're going to assume that trend integrity is going to carry out. This is going to carry the day. The idea is the market gets ahead of itself, needs some time to consolidate. And there's also a little bit of a natural type of alternation of emotion where you have the action in the trend sections where the market's more frantic. It's got to get from one place to another. And then you have the calm trading ranges where, so you also have this alternation of I don't know really where to draw it, but this very high emotion, low emotion, high emotion, low emotion. So you have this conviction thing going on. Now, I've just drawn a very imprecise chart down there at the bottom. It's not something we could really trade, but it's kind of the operating concept. Here are some examples of continuation ranges in real market data, and we've talked a lot about theoretical things. So let's spend a few moments here. First of all, let me just kind of outline the trend structure. So here we have a pullback. And then here we have this outlined range. We have a breakout above the top of the range. And then this is probably actually some type of sloping range. That's one possibility for a range. There are different ways you could analyze this. An upside breakout. We have some trending action here, there's probably a range here, and then some type of downtrending action. So I'm going to get rid of that, but just to, you also can just look at the very simple structure. This is a market that is more or less going up, and that's a perfectly legitimate way to read the market. So what else can we take from this? Well, let me just point out a few more lessons to kind of tie this together. So here we have a very visible high, right? And we will assume that this will provide some resistance. And it seems to. We have several engagements of this resistance. And then we have, look what happens here. This is a failure price rejection, right? This looks like price rejection. Don't be tricked. Is it? I don't think so. I mean, of course, you can find some reason to pretend there was a potential support level there, but I don't really see it on the chart. So this is fantasy. While we might like to say that that's some type of price rejection, I don't think it's fair to do that. Market simply traded down and we had lower time frame exhaustion or something. But then we hug here in the upper part of the range. And what does that set up? Sets up a break of the range. Now, a lot of people would tell you that this is this previous resistance acting as support. I don't know. To me, it's a little bit too creative. But you'll start to see a lot of these things come together. And the main thing I want you to take from this chart is that, first of all, market data is a little bit messier than some of the theoretical things and the swing things when we just look at the outlines, but also just the idea of the market acting, of continuation ranges. Here's a reversal range. So there's a lot we could see on this chart, but let's just look at this reversal range down here. So market is trending down, goes into a sideways range, and this does turn out to be the ultimate extent of the trend for at least some considerable time. Now, a few things that people will talk about ranges you need to at least be aware of. The shape of the range. We're going to do a unit on this in the future, so we'll hold off talking about this too much, but a lot of the patterns of traditional classical chart analysis are really variations of trending action and trading ranges. Like all of these things fit together in so many different ways. You add a little bit of randomness, you add some cognitive bias, and you come up with a ton of different patterns. Just be aware that if you pick up some of the classic books, they're going to give you variations of shapes and pennants and triangles and all these different things. They're really kind of very much the same thing. I don't think the shapes of the ranges are as important as their function. And the function we can determine to some extent by where it is in the trend and other factors around the trend. That's a major focus of what we're doing here. There's no easy answer to that. In my experience, the shape of ranges does not generally help predict whether they're continuation or reversal ranges. It would be great if we could say that a range that looked like cat ears was going to be a reversal range, and that is in fact what some books would have us believe, but I've not found that to be true. In fact, I would tell you the shape of the range is not important. Now, what do I mean by shape? Let's look at a few shapes. So one is, and you picture this, of course, in the context of the market, that you'd have a lot of stuff going on in here, right? There's a lot of potential noise, but the basic idea is that the confines of the range are more or less parallel. And compare that to add a variation of this, which we should be aware of, we saw earlier, you certainly could have a parallel range that slopes against the trend. Here we have an established uptrend, or you could also have a parallel range that slopes. No, it's not very parallel. Parallel range that slopes with the trend. It's a possibility, but the core idea here is looking at the confines of the range and seeing they're parallel as opposed to converging. This would be some type of triangle. This does generally indicate contracting swings, volatility, compression. It can set up some different types of expectations out of this move, out of this type of pattern, but it's a little bit subtle. And then the expanding range, this is, people call this a megaphone or something like that. And you can see, if you had swings, you would have an increasing series of higher highs and lower lows, as opposed to here you have lower highs and probably more or less higher lows. You probably have some inside bar type action going on in that type of range too. Slopes of ranges, as I said, can be flat, slope against or with the prevailing trend. And one thing to think about, let's flip over to this chart. I've highlighted some ranges here, but you might legitimately ask, well, one of the questions you might ask is, why have I not outlined some of the other ranges? And there certainly are things that we could point out. But you also might ask, so is this a range or is this a slower trend here? So here we have a fast trend, then we have a slower trend and a fast trend. Is that a possible legitimate reading? Is this, in fact, a slow uptrend? And yes, these are possible definitions. And by the way, if you're doing your swing analysis with the pivots, you would come to some different answers here possibly. But the idea is that typically, and this is a gross generalization, but from a subjective standpoint, I think of these patterns as showing stored energy. Now, why does that matter? So let's use a downtrend here. So if we have a downtrending market and then the market rallies, my sense, both from a lot of trading and also analysis, though this is a little bit difficult to tease out quantitatively, is that this type of action tends to store energy. That this type of action will tend to lead to a cleaner, sharper move out, as opposed to this type of action where you might have a range, but it's sloping the direction of the trend. This tends to kind of leak or expend the potential in the trend. Now, it's not what happened here. And that's the problem with finding an example that, actually at this particular case, I would say this is a little bit unusual because you have these two very nice, what I would consider very tradable patterns sloping against the trend. This tends to be what we look for. And then you have what I would consider to be kind of a crummier action. This also is, I know we're getting ahead, but it's kind of nice to have a little preview, right? This is downswing 1, 2, 3. So are you really looking to take a move after the third downswing? We would be a little careful about that, right? But let's look at the magnitude of these moves. Just look at the length of the red bars and then look at 4. Yeah, so here our kind of questionable pattern, which was a long extended trend. There's some things going on here with other potential overextension. If you're a divergence person, actually you would not have a divergence. It's interesting. You not have a divergence there. But the lessons, even though this particular example may not carry it out, typically speaking, if we have a trend that a range that bleeds in the direction of the trend, then it tends to be maybe set up a little bit less exciting of a move out of the trend. It's really important to think about the confines of the range and how the range is structured. What do I mean by the confines of the range? Well, there are lots of ranges here. I've marked one. The point that I was making here is that we don't quite get up to the high of the range. And you will certainly see that. Here's another point where the market is trending up. We've set this resistance level. Actually, we've looked at this before, do you remember? And consolidating up against. But if you really were to put a straight edge on this, you would find that some of these days go through, some of these days don't really come close. You would also find areas where, actually, let me just flip over to the next chart because this shows this very cleanly. So here's where we were, not quite up to the high of the range. And then we start to make new lows. Now, at this point, what do we have here? We have a lower low and a lower high at some point. Well, actually, we have lower high there. So we are in a downtrend by our very strict definition we're using this week. But what will very typically happen is that the confines of the range can just be kind of pushed and expanded. And I would tend to read this. In fact, I did in real time. This is not backwards looking analysis. I would read all of this as a big range, and simply to notice that we expanded to the bottom, don't quite get to the bottom. This is acceptable momentum, price rejection from the low, and which you did not have here. Look, you bled through to expand the range down. And then we went through the high here again. Maybe you should say we went through the high here again. So this is normal. We don't see in a very simple textbook case very much this. It's more like we see extending above, or maybe we don't even quite get down to one side or something like that. Maybe we don't quite get down for a long time, then we spike down and off. There's all kinds of things that can happen. One of the things, speaking of spikes, one of the things you need to think about is how are you going to deal with these long shadows? And people deal with them in different ways. There are plenty of people who will just take the body of the candle. And again, just to be clear, this is the body. This middle section is the body. And there's a possibility of having an upper or lower shadow. So what happens if we have a body and then we have a very long shadow? Well, what this shows is the market traded down here and very quickly reversed. So you will have people that will say your operative level is here. I have a problem with that for a number of reasons, but just be aware there are people who do that. And if it's a consistent part of your methodology, then you certainly can use it. But do be aware of long shadows. And speaking of which, the election. Some of these things are very interesting to think how they form with information and news. So patterns, if we think about a range breaking or holding, you already know a lot of this. The patterns at work here are the patterns of support and resistance. What are the patterns of support and resistance? Support and resistance holding, the primary pattern is price rejection. The primary pattern of support and resistance failing, and I'm just trying to anticipate questions. What I mean by failing is, so here's a resistance level, market comes up to the resistance level, failing would be going through the level. Failing in the case of a support level would be the market comes down and the market goes through. Those would be failures. Successful tests would be the opposite. What works in isolation also works at the confines of the range, the extremes of the range, which is where you really want to be paying attention. Some other things to think about. I've hinted at this, but there are some factors with the trend that can give some insight, particularly in these. Again, these are things that can be difficult to quantify, but when it comes from getting a subjective read on the market, there are many factors for trend strength that are important. Multiple tests weaken the range. And here is something that if you've read books on technical analysis, you've been told that multiple tests strengthen the range. Again, do your own work, but I found it to be quite different. And consolidation against the range, against one side of the range, I guess we should say, sets up failure. Why? What is this? Well, this is not news. Look what's happening here. So I've highlighted a range, and then I've highlighted a smaller consolidation up against the top of the range. That's simply failure price rejection. And that's the kind of cool thing about a lot of this. Look what happens down here. So, and then, you had a secondary level here, maybe, which you could say we were engaging somewhere in here. And it's just this failure of price rejection. That's not, let me get rid of that. That's not the cleanest example. This is a very clean example that consolidation against one side of the range will tend to set up a break of the range. And here you have a couple more examples. So these nice longer ranges, you've seen this chart several times, but we're pulling different things out of it. And this we've talked about before. This I'm not sure we talked about earlier in the unit, but it's there. And another good point here, markets love to fake out. This is very common for a market to make a break in the wrong direction before reversing. It makes trading breakouts a little bit difficult. We'll get to that too. So that's a pretty good start, I think, for thinking about trading ranges. A little bit of review here. So there are areas in which the market is in relative balance, and because the market is in relative balance, the market moves with a high degree of randomness. It's hard to read patterns within the range. If you want to focus on something, you probably want to focus on the extremes of the range. So if you have a range, we're not going to really care so much about what happens here in the middle. We're much more interested in what happens when the market gets to one side. Middle is kind of no man's land, no person's land, right? And last, most ranges are continuation ranges because we expect trends to continue. And in fact, they do. So that is all we have for this introduction to trading ranges. You'll have some homework, and we'll do a little bit of time, spend a little bit of time looking into these patterns more deeply. I will see you back for the next unit. Thank you.